What's up guys, Yay Cars here, and in today's video we're going to be talking about car financing. This is something that every single person on the history of YouTube who thinks they know about money, I mean, I'm certain some of these guys probably know a lot more than I do, but literally every YouTuber covers this topic, and I feel like they cover it in the most boringest, monotonous way. I was actually watching some of these YouTube videos and guys like, welcome to my car video about talking about car financing. Yeah, today it's a boring topic. I'm gonna keep it as boring as possible. I don't know, I couldn't even watch it for more than 5 minutes, and it was really good actually. It was a really good video and it kind of explained it and went into good depth, but it's just so boring. So this point of this video is try to explain it to you guys in a simple and as easiest way to understand as possible. So let's get into it. Okay, so for those of you who don't know what financing a car is, basically there's 3 different ways you can buy a car when you go to the dealership or when you buy it off someone. Basically the first is you pay up front with cash. Usually not the best idea. Next is you lease the car, and then the other one is financing. Obviously there's pros and cons to financing and leasing, and I'm going to probably do another video talking about leasing, but to keep it short and simple for this video, we're just going to stick to the financing. So when you finance a car, there's 3 main things. You have the interest, you have your down payment, and then you have the term. So all these combined together basically give you a monthly payment that most of you are familiar with. Now let's take a look at the interest. So when you go ahead and you finance a car, there's 2 main things you can do. You can finance it through the dealer, or you can finance it through your bank. Each places give different interest rates. In my experience, I've had dealers give pretty good interest rates, and I have a feeling it's because they kind of want to sell you the car, so they're more incentivized to give you a lower percent interest. And if you think about it, if a dealership is giving you 2% interest and they sell you the car versus you don't buy the car because the bank gave you 8, of course the dealership is going to take that risk, going to give you a loan at 2% interest because 1, they sold you the car, and 2, they're actually making 2% off that. So now some of you might be wondering, what's a good interest rate? I've seen interest rates go from all the way from 0% all the way to 20%. And usually you get a 0% interest rate on new cars, and this is because dealers want to sell you the car and they're like, hey look, 0% interest, buy my car. And then if you have 20%, I actually saw this dude had 20% interest on his car, and he's like, guys, what do I do? And everyone's just like, are you kidding me? 20% interest? What? How do you even get 20% interest on a car? How bad was this guy's credit? But in general, anything above a 10% interest rate is anything above a 10% interest rate is pretty bad, and anything less than 5% on a used car is really, really good, and anything less than 3% on a new car is pretty good. Now let's take a look at the down payment. So this can be split up into a couple of different things, but to keep it simple, we're just going to go over the very basic understanding. So the down payment is how much you put on the car, which will change your monthly payments. The more money you put down, the lower your monthly payments. So in general, people recommend putting around 10% or so-ish of the car's value as a down payment. So if you have a $50,000 car, you're paying around $5,000 down payment initially. However, it really varies based on your interest rate. If you have a low interest rate, like 0%, then I say put no money or as little money down as possible, because your money is better spent somewhere else. Whereas if you have a high interest rate, anywhere between 6 and 7, probably try to put more money down. Okay, so at this point in the video, some of you might be like, hey, I'm kind of confused. There's interest rates, there's down payments, there's percentages, there's numbers. Can you do an example? And I'm going to do an example for you guys, and I'm going to try to make it as simple and as easy to understand, but I have one more thing to go over. I'm going to be going over the loan term. The loan term is basically how long you're going to take to pay off the amount that you finance. In general, it's 1 year, 2 years, 3 years, 4, 5, 69, 420, although most banks and dealerships aren't going to offer you more than 10-year finance, with the average being 4 to 5. And sometimes they do 12 months, 24, 36, 48, 60 months. Actually, most of the time they do months. I don't know why, there's probably a good reason for it. Okay, how does this all kind of tie in with everything else? The longer your term is, the less you're going to pay for the car. The shorter your term is, the more you're going to pay monthly for the car. However, the only problem with a higher term or longer term is that you're going to be paying more to interest. And if you're confused, don't worry. Even I'm explaining it right now, it's kind of hard to conceptualize in my head as I'm explaining it, even if I understand it. So I'm going to do an example right now. Okay, so something I forgot to explain is what happens if you trade your car in. And just to keep this video just about financing and down payments, I'm not going to go over it, but if you have any questions, let me know in the comments and I'll gladly answer. So what I highly recommend you guys do before we look at the example is that you go and you Google car payment calculator. Go find out what numbers your down payment, your interest rate, I don't know, whatever numbers that you get from the dealership, put put these numbers into the calculator and see for yourself. I'm going to do 2 examples, and I'm just going to do these examples to kind of show you what I meant by, if you have a higher interest rate, it's kind of bad to have a longer term, and if you have a lower interest rate, it's okay if you have a longer term because you're not paying as much money to interest. So now let's say you're someone who has kind of bad credit, you get a 10% interest rate, and then it's a $35,000 car. We're putting down 10% like I mentioned before, which is $3,500. So how much do we pay? We pay around 700 something-ish dollars a month, but the biggest thing is if you look at the interest rate over 60 months, we're looking at $9,200 just in interest, which to me is crazy. Now let's see what happens if you have good credit and you have a good interest rate. If we only change the interest rate from 10% to 3%, our monthly payments go down to $600 a month, and we're only paying $2,600 a month, which is nearly $7,000 that you're paying less over 5 years just because of interest. And that's it, guys. That's all for today's video. I hope you enjoyed it. If you did, consider subscribing. Drop a comment with what you liked about this video and what you didn't like. I'd appreciate all your feedback. Was it simple enough? Was it too complicated? Did I ramble on too much? Do you guys want to see more memes? I don't know. Let me know what you guys want to see in the comments. And as always, I'll see you guys in the next one.